The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. on this Tuesday. Let's get a check on where things stand.
Wednesday.
Is it Wednesday already?
I think yesterday was Tuesday. Today is Wednesday.
Okay, all right. I don't know what day of the week it is. All right, let's take a look at what's happening on this Wednesday afternoon. We did get a jobs report. Maybe that's why everything's so confusing. Jobs reports tend to come out on Friday, but this was a delayed jobs report because of the partial government shutdown. Right now, the S&P 500 is higher by 0.1%, but that December jobs report, or I should say January jobs report, caused traders to reprice the timing of when the Fed resumes its rate cuts later in the year. And we're definitely seeing small caps, which had outperformed big caps for the last 6 months, get dragged down a little bit more. They're certainly more sensitive to rate cuts. Where you really saw movement, of course, is in the Treasury market. Treasuries selling off, that is pushing yields higher, especially at the short end of the yield curve. The 2-year, obviously much more sensitive to Fed policy. And Bitcoin, Katie, we had to check on Bitcoin, currently at 67,000. It did not go above 70,000 today.
No, not today, maybe tomorrow. Today was jobs reports Wednesday. Let's not make it a thing. And well, the U.S. labor market may have found its footing, adding the most payrolls in more than a year back in January. But it's not all good news. Job revisions for 2025 showed a marked slowdown in hiring, with gains dropping from an average 49,000 new jobs a month to just 15,000. All in all, the data likely means that the Fed will keep rates on hold for now. Many traders appearing to push out the timeline for the next rate cut from June to July, but we know that that could change, with economists reminding Wall Street that the upbeat report could be revised lower, and just a handful of sectors continuing to drive hiring, primarily healthcare. Now, the other place that Wall Street is looking for clues about the economy is, of course, corporate earnings. McDonald's, it could give a solid temperature check on how America's low-end consumers are spending. That's out after the bell today. But before we get to that, actually, this close will speak to the CEOs with Robinhood, Strategy, and NOVO Nordisk, all of which reported results within the last 10 days. Scarlett, it's going to be a really busy show.
Absolutely. Looking forward to all those conversations. You mentioned the jobs report. We often say that every jobs report is backwards looking. Well, in this latest report, the government revised numbers for all of 2025 that really paints a different picture of the labor economy than what we had thought. And the verdict is that the U.S. economy only added 181,000 jobs last year. That's this bar right here. So if you exclude recession years like 2020, COVID, and 2009, 2010, the Great Recession here, that 181,000 is the lowest annual total since 2003. It averages out, Katie, as you said, to 15,000 job gains per month, down 70% from what was initially reported. So the question now is whether investors have less confidence that the reported January jobs increase of 130,000 will stand the test of time or also get revised down a year later.
Well, let's keep the conversation going now with Ed Yardeni. He is president and chief investment strategist over at Yardeni Research. Ed, it's great to have you with us. I opened up your recent research, and you point out that we're in the year of the galloping horse, or we will be when it comes to Tuesday and the Chinese zodiac flips. You make the point that the 2026 horse is likely to be a racehorse because it will be fed a very stimulative diet of steroids and speed this year, which obviously caught my eye, Ed. You were mostly talking about that in the context of real GDP, but talk to us about how the labor market report we got this morning sort of fits into that.
Well, it's very good news, clearly. I have been thinking that the labor market might surprise us this year to the upside because everybody's so pessimistic about the labor market. But the labor market got hit by all sorts of uncertainties last year. I think it's actually going to pick up some. And so I would not be surprised if the run rate is more like 100,000 per month than the widely expected 50,000 per month. But the other thing we've got going for us is the refunds that people will get from their tax returns will be on average about $1,000 more than they got last year. So altogether, the average refund is expected to be about $4,000 for the average taxpayer. And so that's going to be stimulative. Fiscal policy is stimulative on the tax cutting side, but it's also going to continue to run large outlays. And so put it together, we've got very stimulative deficits. And then, of course, monetary policy, the Fed lowered interest rates, starting in September 2024 by 175 basis points. I think it takes a little bit of time for that to really stimulate the economy, and I think it could be doing so this year, as evidenced by a pickup in bank loans.
Given the job revisions that we saw for all of 2025, Dr. Ed, how are you thinking about how reliable these numbers are and whether they really paint an accurate picture of the U.S. economy?
Well, they're pretty close to useless, at least the preliminary ones. The preliminary ones, with the benefit of these benchmark revisions, turn out to be way off, not just on for a year, but kind of on a month-to-month basis. And yet here we are kind of reacting to the monthly data. Who knows what kind of revisions await the number we just got today. But look, I think when you look at all the labor market indicators, you do get a picture of a labor market where hiring has slowed down to the point where businesses aren't hiring more than they need to replace workers, either from layoffs or separations. Hence, we really haven't had much, if any, growth in employment. That's the bad news. The good news is the economy has been growing despite that. GDP has been very strong, and so the clear implication is that productivity must be absolutely booming. And the great thing about productivity is it does benefit workers because I think we will see wages rising faster than prices.
And I am curious, what you make of today's price action. I know it's hard to read too much into a single day, but you take a look at the reaction to that print that we got at 8:30 this morning. The S&P 500, it initially popped. It opened much higher. Those gains have faded. But then you take a look at the bond market, really holding its move. You saw that sell-off. Yields spiked up, and they pretty much stayed there, Ed.
Well, the bond market's actually been remarkably quiet for quite some time here with all the commotion that's been coming out of Washington, out of the global economy. Japanese bond yields have been soaring, and yet our bond market's been just kind of sitting there around 4.2%. And I think it's basically still doing that. I think there are investors who've made a lot of money in the stock market and are rebalancing into the bond market, rebalancing into gold. So I think that's how you can explain how the stock market can go up, and yet the bond yield doesn't go up, and gold continues to move higher. Put it all together, and I think investors are of the opinion that the economy is in good shape, notwithstanding the sluggish pace of hiring, and that it is based on productivity, and that technology, particularly AI, is making a difference in terms of boosting productivity. Right now, what we're seeing in the stock market is sort of everybody's scrambling for AI immunity. It's kind of ironic. After ChatGPT was introduced back in 2022, everybody was scrambling for the AI trade to go long the Magnificent Seven and other technology companies. Now they're trying to figure out, okay, what can I buy that isn't going to be threatened by AI technology?
I really like that phrase, scrambling for AI immunity. I'm going to steal that one, Dr. Ed. So you mentioned the rebalancing and rebalancing into other asset classes beyond equities. And you mentioned gold as part of that. Gold is back to gaining once again after taking a big tumble from those highs that we saw in late January. How much more of that rebalancing do we need to see? I mean, is this something where we're kind of 2/3 of the way through, a third of the way through?
Well, I think this goes on for a while because it much will depend on what happens in the global stock markets and in the U.S. stock market. My base case scenario is a very optimistic one in which I think that we're already about 6 years into the roaring 2020s. So this is the 7th year of the roaring 2020s. I think by the end of the decade, and I'm assuming no recession, we had a lot of fears of recession since the beginning of the decade. I wasn't in that camp, and even now it's clear to me that given the resilience of the economy, if we have no recession, I think the stock market could be discounting something like $500 a share at the beginning of the next decade. By the end of 2029, multiply that by 20, you get 10,000 on the S&P 500. If that optimistic scenario works out, I think rebalancing into bonds and into gold will get the price of gold up to possibly as high as $10,000 per ounce.
Potentially as high as $10,000. That's a good place to leave it. Ed Yardeni, really appreciate you joining us.
Thank you.
Ed Yardeni, he is the president and chief investment strategist over at Yardeni Research. Now, coming up on The Close, we're all in on earnings, talking to major CEOs with quarterly reports out in the last 10 days. Those include Robinhood's Vlad Tenev, NOVO Nordisk Mike Doustdar, and Strategy's Phong Lee. All join the program today to discuss.
Now, from the CEO playbook to the quarterback's playbook, newly minted Hall of Famer Drew Brees joins us alongside Stretch Zone CEO Tony Zaccario to talk the world of physical health.
And then we'll discuss the clothing behind athlete success. Nike CEO Elliott Hill has an exclusive sit-down with The Close's Romain Bostic about the future of athletic wear and how the brand is innovating in the space. All that and more coming up. This is The Close.
All right, shares of Robinhood are under pressure following earnings. That late 2025 crypto rout leading to a revenue miss for the trading giant. I'm pleased to say we are joined live by Robinhood CEO Vlad Tenev today. Vlad, thank you so much for talking with us. As I mentioned, lower crypto revenue due to the sharp declines in Bitcoin and other cryptocurrencies. I'm curious, what kind of internal assumptions are you making about crypto trading and crypto price action this quarter and the rest of this year?
Yeah, I think we try to really stay focused on the long term as we think about the business. Robinhood is the beneficiary of so many tailwinds that are materializing as we speak. The 100 trillion wealth transfer from older generations to younger, an AI super cycle that we see playing out in higher productivity, so many announced private companies, including space exploration companies and frontier AI labs that are expected to be entering the public markets. And I think all of these are converging to make it an environment where we expect more and more people to be investing in the equity markets. The quarter, now that we're a diversified business, I think there's always some sector that might be temporarily under pressure. In this case, it's been crypto, but we're still tremendously bullish on crypto as an industry and as a fundamental technology. In fact, just after earnings, we announced the testnet of Robinhood chain, which we intend to be the world's #1 chain for trading real-world assets, for the tokenization of real-world assets. And so we're pushing ahead with tokenization, and we see a world where crypto and TradFi increasingly converge, and we think we can be right at the center of that.
Well, Vlad, you mentioned the concept of super cycles. And speaking of super cycles, you said on your earnings call yesterday that we're just at the beginning of a prediction market super cycle. And certainly you wouldn't be alone in that view. But when you think about Robinhood customers on prediction markets, do you have any sense of what kind of returns that they're seeing? There has been some research out there and some concerns about big losses coming from prediction markets.
I think these things tend to be volatile. I mean, 1 month you'll see returns, the next month not. I think what we're building towards is an integrated financial super app where you'll be able to trade and invest in and hold any asset, as well as do your banking with us and your spending through the Robinhood credit card. And I think we're unique in our category because most of the prediction markets platforms are kind of single purpose. You can only trade prediction markets. But what we've been seeing increasing success with is bringing customers in with prediction markets, because prediction markets attract a new type of customer. They allow you to trade pretty much anything. And then once they're in the door, we cross-sell them lots of our other products and build a deeper relationship. And you look at retirement, for instance, retirement is at 26.5 billion assets under custody. We've given out over $500 million in matches, and the assets under custody is up over 100% year over year, more than double. So I think looking at each of these things in isolation is not how we look at it. We look at it as the overall relationship and how can we make sure we are helping customers with the totality of their financial needs, from their paycheck direct deposit to their long-term savings, to their retirement savings, and of course to the discretionary trading activities like futures, options, and increasingly prediction markets.
So, Vlad, do you plan to offer, are you looking to offer margin for prediction markets?
I think that that's subject to the exchanges filing for it. I think that margin can be useful for active traders, and if there's something that there's clarity on and we see the demand, I think we would explore it.
And I'm curious about, the recent majority take that you took in LedgerX with Susquehanna. I know that currently you work with Kalshi, of course, when it comes to prediction markets. But, Bloomberg Intelligence has said that more than half of Kalshi's business in recent months has come from Robinhood. How might your relationship with Kalshi change should you actually start to launch what you've invested in?
I think Robinhood has many businesses. Of course, we have our brokerage business, but we do also have exchange businesses. On the crypto side, we acquired Bitstamp, and so now we have a fully featured global crypto exchange. You mentioned the joint venture with SIG on Rothera, our new prediction markets and derivatives venue. The way we think about it is when we offer our products to customers as a broker, we want to give the customers the best selection, the best pricing, and the best execution quality among all of the exchanges. So take crypto, for instance. We, of course, route to Bitstamp, and Bitstamp does quite well, but we don't exclusively route to Bitstamp. We route to whoever gives our customers the best pricing. Same with equities. And so I think we should expect the Rothera acquisition to certainly take a larger portion of our volume, but we'd still continue to route, and we see a world where the prediction markets exchange space is more and more a multipolar world where the exchanges will compete to offer the lowest pricing and the best deals to brokers such as ourselves.
All right, Vlad, unfortunately, we have to leave it there. Always great to speak with you, though. That is the CEO of Robinhood. His name is Vlad Tenev. Now, coming up, investors souring on Lululemon as the company tells employees bonuses will likely be below target this year. We'll discuss if this is yet another sign that the athleisure giant is stretched thin. This is The Close on Bloomberg. President Trump's energy chief, Chris Wright, arriving in Venezuela today, meeting with the nation's new leader, along with oil producers and other officials, as the U.S. pushes to revive Venezuela's beleaguered oil sector. Bloomberg surveillance co-host Annmarie Hordern joins us now live from Venezuela. Annmarie, so give us a little bit more detail here. What will be on the agenda and what will they be discussing?
Well, this is certainly an historic trip. And when you talk to individuals on the ground, some of them are comparing it to the United States in terms of the hype left in 2019 when we shut down that embassy, that they're now here to bring back up and open and trying to, again, have a presence in Caracas. Another individual said to me that some people are talking about this as big of a deal as when Bill Clinton last visited Venezuela in 1997, of course, the final year before Hugo Chavez took over this country. So this is really a remarkable moment for this relationship between Venezuela and the United States, especially given the fact that it is now being led by interim President Delcy Rodriguez following U.S. Special Forces capturing Nicolas Maduro very early on, January 3rd of this year. What is happening right now at the presidential palace is we had a bilateral meeting between Secretary Wright and Delcy Rodriguez. Now they are sitting down with both their teams. What I found so interesting is going into the meeting that we just saw at the top there and some of the pleasantries and introductions, there was a huge map outside this beautiful palace meeting room looking at all the hydrocarbons that are in Venezuela, which is why you have the first high-ranking U.S. official to visit this country following the capture of Nicolas Maduro, being the energy secretary. This is the heart and soul of this country's economy, and to get it back up to functioning. And that is why you have this individual here. So he's going to be not just meeting with government officials, but also local energy companies, as well as looking at some of the Chevron fields. And that is really the tenor of this really diplomatic overture, as both these sides are trying to rebuild trust before U.S. companies make the case to go back in.
Rebuild trust. I think that's critical in how you frame what the stakes are. The White House wants big oil companies to invest in Venezuela's crumbling oil infrastructure, but it's an expensive proposition, and the companies themselves have made clear they need political reforms, security guarantees, and other assurances. Have they given any ground? Have they made any concessions to the White House?
Well, I think that's what you're seeing part of this first trip. All of this will be discussed because obviously for massive oil companies, this is top of mind. Chevron has been here for 100 years. They're not going anywhere. They're the ones that are going to get some of these extended licenses, maybe potentially a company like that could start to produce more, maybe Repsol, Eni from Italy and Spain as well. The ones that have a tremendous amount of interest at this moment are the wildcatters. They're a bit more nimble and they're small. When it comes to the bigger oil players, we heard from Darren Woods of ExxonMobil sitting by the president in the White House saying that it was the security risk that was a concern. And some of these companies lost billions of dollars when basically their assets were seized in this country. So that is why there's a lot of consternation about going back in. But what I hear on the ground is that there is a tremendous amount of excitement and interest from business. They want to hear more, and that is why this trip is actually so important. What is going to be the tone coming out of these meetings?
All right, Annmarie, really appreciate your reporting on the ground there in Venezuela. That is Bloomberg Surveillance co-host Annmarie Hordern. And coming up, we're going to focus back in on the world of GLP-1s and specifically the big players involved. My conversation with NOVO Nordisk CEO Mike Doustdar. What's next for the drug makers? We have earnings in the rear view. Remember, they pre-announced those last week. Also, of course, a little bit more detail on their legal action against him and hers, which has scrapped their plans for a copycat Wegovy pill. All of that and more coming up. This is The Close. It's just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld. GLP-1's a huge part of the conversation on Wall Street this week after NOVO Nordisk filed a patent infringement lawsuit against Hims & Hers regarding its copycat weight loss pill. I had the chance to speak with NOVO Nordisk CEO Mike Doustdar earlier. Here's part of that conversation.
We have for a long time been discussing how we simply don't understand how this compounding has gotten to the level that it has, mass compounding. When you see Super Bowl commercials, then you basically say this is no longer individualized medication. This is mass compounding, and we have not understood it, and we felt not just on the back of the unsafe API that's coming, and we don't know what is being injected into people's stomach. Also, where did IP go? Intellectual property is the backbone of this industry. It is really, really important that, of course, we're allowed to have the exclusivity to recuperate back the investments. If anyone can bypass the FDA and simply put any product into the market, then the system is broken. And I am very happy to see that both FDA as well as, of course, the reference to the DOJ was swift.
Mm-hmm. Well, Mike, you mentioned IP, and to that point, we're talking on Wednesday. Just a couple of days ago, you did file a lawsuit against Hims & Hers for patent infringement here, even though they've scrapped their planned version of your pill. So why proceed with the lawsuit if they no longer have those plans?
The lawsuit is around the semaglutide IP as a whole, not just specifically the pill. And it goes really back to the notion that we believe there should not be mass marketing of compounded products to everyone. I think compounding should be reserved for a few individuals that might have an allergic reaction to our medication, and that would be fine. But I think when it gets into the masses, then I think it needs to be addressed. We also, of course, have really continuously talked about patient safety, and I still believe API coming from unknown sources, often China, without getting the approval from FDA is not a good thing. So it has to be the original API, if anything, and of course, this is something we'll pursue.
And I do want to talk a little bit about the earnings that you did announce last week, because the guide really seemed to surprise Wall Street, and you saw that reaction in shares moving sharply lower. So when it comes to the scope of 2026, I do wonder what the biggest unknown is when it comes to that outlook, either positive or negative, when you think about factors such as your pill uptake, or you think about factors such as Medicare expansion.
I think the biggest unknown is on the volume side. We have said that we're going to grow the volume gradually, and price cuts are happening on day one. And that is why you see the numbers. Of course, the pill has been a phenomenal launch, really a good launch. As of basically today, we have 246,000 people after 5 weeks on the pill. I am very happy with that. But I have to remind you and the audience that the pill starts with zero, while we have more than $30 billion worth of injectable there that got repriced. So while this is going to be, as I've been saying, a year of so-called headwind from a pricing point of view, it's a year of tailwind to come on the volume side, and we have to really work hard to make sure that those volumes materializes, and we're doing that.
Let's talk a little bit more about that dynamic, pricing versus volume, because you've set a price of $149 to start for your pill. Is that the floor, would you anticipate, or would you, perhaps see a situation evolve where you are cutting prices from there?
I think that's a very affordable price right now, and that's where we are at this point. Our pill uptake has been 15 times better than when we launched Wegovy injection. It's been more than twice as good as when Zepbound, our competing product, was launched. So that tells me that that is the right price point to untangle a lot of patients that are right now in need to come and join us. As we go forward, I think pricing in this dynamic world is going to be actually looked upon day by day, week by week, month by month. I think we're in the right place, and now the focus has to be on volume uptake.
Mm-hmm. Well, you mentioned that the launch has been very successful so far, and I have to ask, when you take a look a few years down the line, I know the hope is that the pill will expand your total addressable market rather than cannibalize the injectables, but could you see the pills, the oral form of your drug, sort of surpassing the market for injectables?
I could see that, but honestly, no one knows. This is unknown territory, and we are ready because this is Wegovy pill. As we have Wegovy injection, we have the same manufacturing site, the same API, raw materials, so we can very easily turn the knob between injection and the pill. So we have the flexibility that I would say give us a competitive advantage. But nevertheless, I basically will wait and see before we claim. Right now, as you said, majority of the people, 90% of the people that are coming towards the pill are new patients, new to GLP-1. So that's actually good because it's expanding the market.
And just to follow up on a point you made that, you can sort of shift here, are you talking specifically about manufacturing when it comes to the pill versus injectables? That's
correct. One of the things I think most people don't know, the pill manufacturing is made in U.S. from the very beginning till the very end. That's quite unusual. Many of our peers produce and have their API come from China. They often use Ireland as a hub to do the filling and the formulations, and then they bring the products into U.S. NOVO Nordisk in North Carolina makes the pill from the scratch, basically. The API is made in North Carolina, the filling and the formulation is done there, packaging is done there, and then, of course, it goes out from that to U.S. We export out of U.S. more than we import into U.S. So that's actually quite unique and something I'm very proud of.
I do also want to talk about the deal landscape, of course, because you were involved with that high-profile bidding war for Maziar. Pfizer ultimately won out there, but you are vocally in the market for a deal here, for an acquisition. And I'm wondering, Are you shopping or are you getting approached? What does that look like?
Both.
Yeah.
I would say both. When you have an ambition to go out there and solve the problem of 1 billion people, then you first and foremost look into your own R&D shop and see how we can accelerate and do more. And I'm incredibly proud of our pipeline. But you're also humble enough to say we should not have a not invented here syndrome. We should actually be open to other inventions out there that others have done. So can we go out there and look around? And others also have noticed that from us, are approaching us, and we will basically see when we can complement what has been made outside with what we have made inside and have the best of the two worlds.
And what do you make of valuations at this point, you know, as you do go on this little bit of a shopping trip?
I think no one else better than NOVO Nordisk can value basically these assets. This is our bread and butter and something that we understand incredibly well. Maziar was, I think, a very good example. Our initial bid and our last bid was the same number, and that's because we knew what it's worth to us and what it's not. So we have to have the financial discipline to walk away when it's no longer worth, but also have the generosity of putting our hands in the pocket and pay for whatever the worth of an asset is.
And before I let you go, I am curious, you know, do you have any sort of ideal timeline in mind for, you know, when you might see this deal materialize, or is it really just about finding the right target?
No, I think it's finding the right target. I don't give myself a KPI or a target on quantity of the deals. We have to have the right quality deals that matches the overall strategy that we have. So we will continue searching, and when we find the right deal, you'll be the first to know.
And our thanks again to NOVO Nordisk CEO Mike Doustdar. I mean, what an interesting company at this moment in time. You think about just last week, pre-announcing their earnings, obviously the stock got walloped. Then Hims & Hers coming out announcing basically a copycat version of their oral pill, undercutting them on price. Hims & Hers then having to scrap those plans. Yeah. And all the while, I mean, NOVO Nordisk out there, and they are shopping, you know, and it was interesting to hear the CEO say that they actually have companies approaching them about a potential acquisition.
Well, everyone knows they're in the market, and they definitely have the means to do so because they were pushing against Pfizer to acquire Maziar. Maybe they're kind of happy given what Pfizer reported when it came to those initial Maziar results.
Yeah, no, that is true. But that episode did prove and showcase that NOVO Nordisk is willing to reach into their pockets here. So
absolutely.
It'll be fascinating to see what they do come up with eventually.
Well, let's talk about this more and keep it going and talk about Novo because it is our stock of the hour. Joining us live right now is Jared Holz. He is a healthcare equity strategist at Mizuho Securities. And Jared, I hope you listened to that entire conversation. There's a lot to get through here, but I want to start with something that you have pointed out in your recent note, which is really eye-opening, which is that you could not be more adamant that Novo would be a far better stock today than it currently is if the company had remained predominantly a diabetes player and not gone into GLP-1. Explain what you mean by that.
Hey, thanks for having me. I mean, it was a little bit tongue-in-cheek of a comment to make, but, you know, just sort of looking at the stock performance within, you know, the confines of all the headlines that have taken place, you know, competitively speaking, the Hims & Hers news, you know, everything that's happened in obesity has really crushed this stock. This was a darling a few years ago. And when you just look at the chart between, you know, 2021, call it, and now, shares are right back at the lows. And there are a lot of pharma companies that never got into obesity that have fared way better. So it was more a commentary around, you know, relative performance of the stock versus other peers that had really never delved into obesity in the first place. And now, you know, we're sitting here and it's just alarming to see the disparity between Novo and Lilly, on the other hand, you know, both of whom have drugs that I think are pretty similar, right, or much more similar than different.
Yeah, it's one of my favorite examples of an alligator chart when you compare NOVO Nordisk versus Eli Lilly over the past several years. But Jared, I mean, what do you make of some of Novo's initiatives here to try to right the ship? You know, they were first to market with their weight loss pill. You know, they have a higher dose of Wegovy potentially coming out. CagriSema also on the horizon here. Do you think that that's not going to be enough to maybe close that gap?
I do. I think some of the initiatives are going to be successful. I'm not sure where CagriSema fits in the treatment paradigm yet. We're all looking for, not all of us, but I think a lot of the patient population appears to be looking for more weight loss. And so maybe CagriSema gives that to them. I think it's been an incredible launch. The pill has been really fascinating. 50,000 patients per week on the drug already. That's sort of astounding. So I think first mover advantage. I don't think it's been really talked about enough. We'll see what happens when Lilly gets their approval, probably in the next couple of months, give or take. But I think that's been a very awe-inspiring number that they put out, and obviously Mike talked about it today. So I do think there is some stuff to look forward to, and then we'll see what they do business development-wise too.
You say maybe it should have stayed a diabetes player, but it is a diabetes player. It is an obesity player. As they look around to maybe acquire another company or do some tuck-in deals, which other part of pharmaceuticals should they enter, or should they stick to their knitting right now and double down on diabetes?
Well, I think like the cardiometabolic franchise, whether it's diabetes or obesity, is just so important. I mean, this is the lion's share of the revenue and earnings. It would be surprising if they kind of let the portfolio stay in its current state for too much longer. There are assets out there in the public and private domain. I would think, if I were to guess, the next deal is probably in, that core diabetes, cardiovascular, obesity space. But they can really go wherever they want. I mean, they could find a different vertical to go in altogether. They've done some rare disease deals as well, some hematology deals. So it really could be anywhere. And I think the commentary from Mike earlier is probably true and also pretty pragmatic. I don't think they have to do anything today, but they're obviously in the market.
Well, I'll ask you the question that I asked Mike. I mean, what do you make of valuations right now? When you take a look at the landscape, as you say, there's deals to be done both in the private and public markets here, but are they reasonably priced?
I think it depends. I mean, we've had an awesome rally in biotech over the past 6 to 7 months. A lot of single stocks have been re-rated or re-rated higher. I think it's just it all depends on the buyer and what sort of synergies they can get, both cost and revenue, and where they're modeling the drug projections out over the next 5 to 10 years. So I think obviously, if you go back to June or July of last year, valuations were much lower. On the other hand, we're talking about a sector that I think has matured in a really interesting way over the past year, and so many of the publicly traded stocks that we look at in the assets are later stage. So I think that's part of it. I don't think the sector's too pricey. And a lot of what we're seeing is pretty simple in terms of math or academics when it comes down to purchase price. It's a revenue multiple. So it really just comes down to what the management thinks the drug is going to do from a revenue standpoint over the next decade or so.
All right, Jared, really great to get your thoughts and your reaction to that interview. That is Jared Holz. He is healthcare equity strategist over at Mizuho Securities. Let's take a quick look at what we're seeing when it comes to the broader market. The S&P 500, it's pretty much flat on the day, despite opening up with a gain of about 0.7% after we got that jobs report at 8:30 this morning. You can see just the enthusiasm draining out of this market. We're going to talk about why when we take you to the closing bell next with Dan Suzuki. He is investment strategist over at Schroders. Don't go anywhere. This is The Close. All right, we are about 10 minutes away from the market close on this Wednesday. As we established, I'm Katie Greifeld. This is Scarlet Fu, and Scarlet Fu, as I was just mentioning, a real draining of enthusiasm when it comes to this market.
I mean, yes, because when I came in this morning, futures spiked higher on the news that the jobs report was much better than anticipated for the month of January, which kind of bewildered me because the bond market was pricing in that the rate cuts would be pushed back to July as opposed to June. And then as the trading day went on, whatever enthusiasm there was, as you mentioned, has been draining.
Yeah.
And now we're basically little change on the S&P 500, although still near record highs.
It is really interesting. We were talking about this with Ed Yardeni, that you saw, of course, the S&P 500 sort of give up its gains. The bond market has held on to its move. Yeah. It sold off, and then it stayed there when it comes to yields really across the curve. You're taking a look at 2-year Treasury yields right now, higher by about 6 basis points. So let's get this party started now with Dan Suzuki. He is investment strategist over at Schroders, joining us on set. First of all, Dan, it's great to see you.
Yeah, I was worried that you said draining of like energy, and I thought it was because I showed up on set.
Oh, yeah, I saw you out of the corner of my eye. But talk us through what you're seeing. Again, it's hard to read too much into a single day's action, but initially you saw this burst of enthusiasm. Why the fade?
Well, I think you said it right. You know, the bond market held on to the gains. The implications for the Fed and interest rates is valid, but then there's always this tug of war between, you know, the Fed and growth, right? I think that's the tug of war that the market's dealing with. So I think right now there's been such a the last year has been very much a liquidity story. There's been some concerns about liquidity, some splintering within the liquidity trade, and then you get this concern that maybe the Fed story gets pushed out a little bit because growth is good, and that has mixed implications. So you look underneath the surface of the market, it's not just like everything is flat, right? There's winners and losers in there. I think that ties back to it.
Yeah, and one of the losers, of course, is the small cap index there, the Russell 2000, down about 0.5% or so. So put this conversation in the context of the broadening that we're seeing, because we've been talking a lot about the equal weight, but we've been talking a lot about the small caps, and it feels like small caps, you could argue, are one of the areas of the market that could really benefit here from lower rates.
Yeah, I like that story, but I think, again, like what the small caps, part of the big push for small caps has been the combination of liquidity and growth. And so as you get sort of the liquidity getting called into question, I wouldn't read too much into today. I think as long as they can continue to put up really good earnings growth and meet expectations, I mean, because that's been the issue with small caps over the last few years is expectations get really set high, everybody's excited for the broadening trade, and then the earnings disappoint. I think what you're seeing is that actually the earnings are actually coming through, and if they can continue there, I don't think the liquidity or the Fed getting pushed out a month or two is really going to change that story.
You know, we're ETF fans, and so I'm looking at IGV, which tracks software companies. It is down 2.7% today after recovering from the sell-off that we saw over the last 2 weeks. Ed Yardeni was on earlier, and he called it the scrambling for AI immunity. Everyone's looking for the companies that won't be disrupted and punishing any company that might be vulnerable to AI. How are you thinking about software companies? Because obviously they've sold off quite a bit, and it's not as if every software company is going to get replaced by AI wholesale.
Yeah, I think that's, I mean, what you're seeing is kind of a wholesale sell-off in the space. And it's kind of like, pick your analogy, right? It's shoot first, ask your questions later, throw the baby out with the bathwater. That's kind of what's happening here. Ultimately, when the dust settles, I think you'll realize that there are business models that truly have disruption risk. But I think you're equally going to see a lot of companies that are going to benefit from this. I mean, if you look at some of the companies that have sold off, some of them are actually partnering with the companies, the AI companies that are set to disrupt them, right? That the narrative is about disrupting them. So it's more likely that they're going to see some benefits. But I think, I think if you're a software investor, this is the opportunity to be looking for real opportunities in the space that are getting sold off. But I think if you're just buying the space, I think there are real structural risks that you have to be aware of.
And I am curious, I'm looking at your notes when it comes to portfolio positioning. I was just caught on this line that you think that, one of the more efficient levers of diversification likely comes in the form of international value. And we know that value stocks have been really hot and cold when it comes to the U.S., maybe a little bit hotter than usual lately. International value, that sounds like you really need a strong stomach there. Well,
I think there's a couple things to point out there. First of all, international value bottomed like a couple of years ago, right? So this isn't like a new trade. Like the value in the U.S. story is really a this year phenomenon. I think if you look at international value, it's been happening for a while. And I think that when I think about the biggest problem in portfolios today, it's that of expensive concentration in portfolios, right? Everybody's hopped up on U.S. growth. Well, if you want to balance out the risk associated with U.S. growth, what better way to do that than the polar opposite of that? Flip U.S. on its head, you get international. Flip growth on its head, you get value. International value is a way that you get efficient diversification, but you can do it in a way that's not a detractor from returns. In fact, international value is basically giving you S&P-like returns over the last few years without S&P-like concentration. I like that combination together.
The seeking out of international value is all about, I don't want to call it sell America because everyone keeps saying that that's not the case, but the diversification, right? Yeah. Let's spread our assets out beyond just being loaded up on big tech in the United States. We also know that treasuries are under a lot of, not pressure, but people are questioning whether there's a slight shift out of treasuries. China, for instance, telling its banks to maybe pull back on the reins when it comes to U.S. Treasury holdings. So far, it doesn't seem very disruptive to the Treasury market, and the Treasury market isn't panicking. But over the long term, what do you see as the costs of that?
Yeah, I mean, I think the longer term story is really where you have to factor in all these risks and look at the opportunity. I mean, longer term, I think, the U.S. can do okay, but there's just tons of opportunity being left on the table because people have ignored, opportunities outside the U.S. for so long. So if you're right and people are buying less treasuries, that's going to mean a weaker dollar. Well, we're coming off this 15-year boom in the dollar. What do you think is going to happen over the next 10 years when, the dollar tends to be mean reverting? It's quite expensive relative to history. I think when you put all these trends together, combine it with deglobalization, that's just the currency story. Then you layer on the valuation story, which is a terrible timing indicator, but an amazing predictor of longer-term returns. When you combine those two things together and then add on positioning if you want to, I think there's a huge opportunity for diversifying outside the U.S. But no one wants to do this because as you get closer to the peak, people assume that dominance is never going to end, and they've been burned on that trade before. But go back to the last 75 years of super cycles. This is what it feels like as you approach the peak. Like no one thought Japan's dominance and Nintendo, Panasonic, Sony, that was going to end back in the day. Internet stocks, the winners ended up being a completely different set of U.S. tech stocks than the ones that are originally priced to benefit from the internet. Right?
Absolutely, Dan. Reminder. Good place to leave it. Great to see you again. That is Dan Suzuki. He is an investment strategist over at Schroders. And it's interesting. I mean, you think about sort of the tech leadership, how it's changed when you measure out by decades. I'm just still stuck on the fact that I think it was Alphabet, right, that issued that 100-year bond, yes. And we haven't seen that since Motorola. And I
mean, not that any of these companies, string it out to maturity. They repay it much earlier than that. But that idea that a tech company is still going to be around in 100 years, we don't even know what's going to happen next week.
No, and we'll see what happens in the next few minutes. It's a global simulcast. Starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld here with Scarlett Fu. Romaine Bostick out on assignment here to help take us through the closing bell. It's a global simulcast. Joining us now is Carol Massar and Tim Stanovic. We bring together all of our audiences to talk about a market day that's ending again, Carol, without fireworks. We came in, we saw futures surge after that jobs report, and now it looks like we're going to finish up pretty much unchanged on the day.
Yeah, kind of ho-hum, but you're not if you're a part of the AI or latest leg of the AI scare trade. And we're definitely seeing that with real estate services stocks dropping sharply as investors assess the sector's vulnerability to the newest crop of AI applications and tools that could disrupt many industries, including real estate. So, Tim, this is something that came on your radar. I mean, Jones Lang LaSalle, Cushman and Wakefield, and CBRE all seeing some hits today.
You say Romaine's on assignment.
We did, yeah.
He had him on our show earlier today.
We'll have him on our show
just
later.
About a half hour ago. He's in Milan. We checked in with him. Everything is fine. Everything is going great. I said, I'm sorry, Romaine, that you drew the short straw and you had to go to Italy for the week. But he said he's actually having a really good time despite all the hard work he's doing.
Tim, aren't you supposed to talk about Bitcoin here? I'm thrown off.
No, I just wanted to fill everybody in on
where Romaine is.
Yeah.
Working hard in Milan.
He's working hard.
And he'll be back.
Assignment.
Romaine, call in. Feel free to call in anytime. Talking about that idea that real estate services stocks are now the latest victims of the AI scare. I loved what Dr. Ed Yardeni told us earlier. He was talking about this scramble for AI immunity, and that's why you see gold, for instance, continue to recoup some of its losses from late December, late January, I should say, and it's back in the upward trajectory.
Yeah, I like what Matt Levine called it in his money stuff today, the AI whatever apocalypse trade, because that's what it feels like. The S&P 500, it is going to finish flat on the day, maybe slightly lower if you're a pessimist. You could say the same about the NASDAQ, down about 0.2%. The Dow Jones, it's down about 0.1%. The big loser today was the little guys, though, the small caps. That index, if we pull out here, you can see it finished down about 0.4%. Carol, of course, as those Fed rate cut bets got pushed out.
All right, let's go to the S&P 500, guys. 285 names in the index, higher today, 218 to the downside. Scarlett, 1 unchanged, so a little bit more of an upbeat slant there to the S&P 500.
Yeah, and you see that reflected in the sector performances as well. There's 11 groups in the S&P 500, and 8 of them are higher. They're in the green. Energy up 2.6% as a group on the day. We know that big energy companies are in Venezuela with the Energy Secretary Chris Wright. Consumer staples also gaining more than 1.5% or 1.4%, and materials up 1.3%. The laggards, financials, communication services, and consumer discretionary.
All right, let's take a quick beat here to take a look at McDonald's earnings. And the red headline on the Bloomberg terminal is their comp sales for the fourth quarter coming in at 5.7%. That was the increase there. That is above the estimate of about 3.76%. So good news there when it comes to comp sales beating estimates. The same could be said of fourth quarter revenue as well, coming in a hair above $7 billion. The estimate had been for $6.83 billion. You can see traders trying to decide what to do here. Currently, the stock higher by about 3% after hours.
Remember, in an environment where consumers are focused on value, that's exactly what McDonald's is leaning into and has been. The company's chairman and CEO, Chris Kempczynski, saying that McDonald's value leadership is working. Quote, by listening to customers and taking action, we have improved traffic and strengthened our value and affordability scores. That focus helped increase global system-wide sales by 8%, delivered strong comp sales growth across all segments this quarter. The momentum we've built reinforces the progress we've made with our strategy and has earned us the right to look forward together as a system.
All right, so just to rehash, we've got now McDonald's bouncing around here, but up about 2.7% here in the aftermarket. Again, U.S. sales growing at the fastest pace in more than 2 years in the fourth quarter. Value meals continue to resonate with cost-conscious diners. Companies' focus on affordability helped improve traffic in the fourth quarter. Diners also spending more per visit in the United States due to successful marketing promotions. That's the words of the company. And so our team kind of doing some analysis. Red Brown, thank you so much at Bloomberg News, saying that the results suggest that McDonald's is gaining market share as consumers change their spending habits in response to higher costs, despite a decline in operating margin that did miss Wall Street expectations. Always keeping an eye on margins. All right, as we watch for some more earnings, including Cisco to report after the closing bell, let's go to some of the individual gainers. This was the number one gainer in the S&P 500. We're talking about Generac Holdings. This one finishing just off its highs of the day, but still good enough for a gain of about 18% in the Wednesday trade. Maker of generators forecasting a 2026 EBITDA margin range with a midpoint above analyst consensus. We should point out that net sales for the fourth quarter did miss analyst estimates, but KeyBank coming out and saying that they do expect shares to trade higher on that 2026 outlook and positive data center developments. Keep in mind the stock's up about 60% year to date. Third best performer in the S&P 500 here in 2026. We caught up with the company's CEO, and they really entered big time in the fourth quarter into the AI world, and that's by offering up some large megawatt generators. So that is a big play and big generator, pun intended, when it comes to their financials going forward. So some good stuff there. This is one we don't talk about. Ticker is SW, Smurfit Westrock, and that one finishing with a gain of just shy of 10%. Stock is up about 30% year to date, and again, a top gainer in the S&P 500, up the most, I think, since around July of 2024 after the packaging company reported adjusted EBITDA for the fourth quarter that beat the average analyst estimate. So some outperformance there. And one more, Micron Technology, great reader when it comes to the semi space, up almost 10% in today's session, a top gainer in the NASDAQ 100. The company CFO, Mark Murphy, assuring investors that the company is producing its new, much-prized HBM4 memory chips in high volumes. That product line is the latest generation of Micron's high-bandwidth memory now being delivered to customers. Murphy coming out saying this during a research event put on by Wolf Research. And that stock is up about 40% year to date, Tim.
All right. Well, Cisco just crossing. Second quarter adjusted earnings per share did beat estimates. Second quarter adjusted gross margin coming in shy of estimates at 67.5%. Second quarter services revenue, this is a look back, $3.71 billion. That beat estimates. Second quarter adjusted EPS beat estimates at $1.04. Second quarter product revenue beat estimates at $11.64 billion. Second quarter revenue all in coming in just above estimates at $15.3 billion. Here's the red headline, though, and it's the outlook. Cisco sees fiscal year adjusted earnings per share $4.13 to $4.17. The company saw $4.08 to $4.14 after hours. Scarlett, Cisco shares higher by about 1.5%.
Yeah, you gave the bottom line outlook from Cisco. Here's the top line outlook from Cisco. Full year revenue, $61.2 billion to $61.7 billion. Previously, it had seen $60.2 billion to $61 billion. So raising the range of its revenue forecast there. You can see the stock currently up about 1.3% at the moment.
Oh, the company boosting its dividend 2% as well to 42 cents per share. Just a little preview for what we got coming up in just a few minutes. Woo-Jin Ho is senior hardware and networking analyst. He's on set with us right now. He's listening. He's looking at the Bloomberg. He's taking notes for what we're going to be talking about. Cisco shares higher by about 1.1% in the after hours. Let's go to some of the decliners on the day while we potentially await more earnings and analysis. Shares of Mattel, look at this, 25% to the downside. This is the biggest plunge going back to 1999. Holiday results fell short of analyst estimates. The company issued a 2026 forecast for lower profit. The stock was up 6.1% through the year for the close of regular trading yesterday. Fourth quarter earnings, excluding some items, totaled 39 cents a share. That missed the 54-cent average of analyst estimates. The company said that shortfall in December sales in the U.S., that grew less than projected. Also, shares of Robinhood taking a tumble today. The company announcing earnings yesterday after the close. Shares fell today by 8.8%. Lower fourth quarter profit due to sharp declines in Bitcoin and other cryptocurrencies. But Vlad Tenev, he said that the company's at the beginning of a prediction market super cycle. He aims to expand into several new markets later this year. I know you guys spoke with him a little about an hour ago.
We did.
What did he tell you? What did he say?
Talked a lot about prediction markets and that super cycle. We talked a bit about, what kind of returns their customers are actually seeing when it comes to prediction markets.
Hold on. Did you say returns in prediction markets?
I did say
You're talking
that.
about returns like we're talking about returns on a stock.
Right.
Or winning.
Is that
bet.
how we should be looking at prediction markets?
Well, I'm not making that case, but I am talking about, whether or not people are seeing money when they make bets on prediction markets. Or
I heard the house
losing
always wins.
A lot of market money. Well, that is the sneaking suspicion out there, Tim. And certainly there's been a lot of research, a lot of academic studies, and also just a lot of concern about, whether people are getting their faces ripped off. So
yeah, I mean, I think, and Carol brought this up a little earlier on our program when we were talking about this, the regulators out there, right? If you're a sports gambling site or app and you're regulated in a different way than one of these like a prediction markets app, like, we got to potentially see some regulatory changes down the line, or regulatory risk, I guess you could say. Finally, shares of Lyft taking a hit today. The company fell after the shares fell after the company issued a disappointing forecast. It missed Wall Street estimates, down 17% on the day today.
All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. Of course, Scarlett and Katie continuing there on the TV side on the close, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place tomorrow.
And coming up, Bitcoin continuing its slide, a full discussion on how crypto companies are managing with strategy president and CEO Phong Lee. That conversation up next. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Scarlett Fu. We had a delayed January jobs report that really threw the market for a loop.
Yeah, indeed, when you take a look at the intraday action there.
Absolutely. All right, let's show you what happened. You have the S&P 500 unchanged on the day. And really, this was after it had opened higher and declined. And now, in the end, everyone's kind of shrugging their shoulders. But there's definite movement in the bond market, which saw a sell-off, pushing yields higher, certainly at the short end of the yield curve, with the 2-year up almost 6 basis points at 3.5%. Basically, traders are repricing the resumption of Fed rate cuts to later in the year, to start in July rather than June. Small caps, which had been outperforming big caps, definitely took it a lot harder because they're more levered and certainly rely on interest rate cuts a lot more. And keeping an eye on Bitcoin, 67,000 right now. It's been bouncing around, but never got above 70,000 today, Katie.
We will definitely get back to Bitcoin, but let's take a quick look here at some of the movers underneath the hood when it comes to this equity market. I put up 2 memory chip makers up there because Micron had positive comments about their execution. That lifted shares by about 10%. Also lifted shares of competitor SanDisk higher by about 10.7%. And then Robinhood, as we were discussing, they reported earnings after the close yesterday. We had a conversation with CEO Vlad Tenev about an hour ago. Basically, their crypto business has been cooling off a little bit. Shares down about 9%. And on the topic of crypto, let's get to our top story this hour. We know that Bitcoin has had a very rough start to 2026, and that has really dragged down the shares of digital asset treasury companies. These are companies that, of course, hold gigantic amounts of Bitcoin on their balance sheets, down about 20% as a group so far this year. You compare that to the NASDAQ 100, you compare that to the S&P 500, which of course have posted gains so far in 2026. So let's talk to arguably the pioneer in the space of so-called DATs. Phong Lee, President and CEO of Strategy, joins us now. Phong, great to talk to you again, and just set the scene here, because when it comes to the performance of DATs, it's obviously very closely tied to the performance of Bitcoin itself. So what possibly could be the catalyst to sort of reverse the performance that we're seeing in digital gold right now?
Thanks, Katie. Look, Bitcoin is digital capital, and as digital capital, it's a non-sovereign, decentralized store of value asset that's supply limited, and it's digitally engineered to do so. And it sees up and down volatility because of its digital characteristics. When Bitcoin goes up, you'll see DATs go up more. That's how Strategy is engineered to be amplified Bitcoin. And as Bitcoin goes through a bear market, Strategy goes down more. I think the interesting story is we've engineered something to protect investors who want access to digital capital without that volatility, and that's Stretch. And to me, the story of the day is Stretch closes at $100, exactly how it was engineered to perform.
And I want to talk a little bit about your financing, about your purchases, because when I take a look at your last 3 weekly purchases of Bitcoin, you've been consistent in the market, but you've sold about $370 million when it comes to common stock, only about $7 million when it comes to your perpetual preferred shares. So my understanding was that you were going to make the preferreds your primary funding source. So far, that hasn't been the case. And I wonder why and what that says about demand.
Well, we've seen, as an example, last year, Stretch and our perpetual preferreds raised $7 billion. That was 33% of the entire preferred market last year. We're educating customers on what a preferred can do. 11.25% returns, cash dividends, tax deferred, paid monthly, 5x over collateralized. There's no other asset class like that out there, but it does take some seasoning. It takes some marketing. This year, we've seen extremely high liquidity with our preferreds, about 150 times other preferreds. And as we go throughout the course of this year, we expect Stretch to be a big product for us. And yeah, you're right, we will start to transition from equity capital to preferred capital.
I need to ask you about whether Strategy would be selling Bitcoin. Both you and Michael Saylor have been talking a lot about this because this is clearly a question that is put to you quite often. Michael Saylor has been very clear, saying that Bitcoin is not, the idea that Strategy is going to sell its holdings were unfounded. You have made the point that if Bitcoin trades down to $8,000 for 5 years straight, you might need to sell your Bitcoin. What are the conditions under which Strategy might need to sell Bitcoin beyond a certain price level?
Yeah, it's a topic that people like to ask the question because I think there's doomsdayers that would like to see Bitcoin fail. If Bitcoin was to go down 90% for 5 years sustainably, we would need to potentially sell our Bitcoin to satisfy some of our convertible debt. It's not going to go down 90% for 5 years. It's extremely unlikely. People don't ask folks, well, what happens if Apple stock goes down 90% for 5 years? What would happen? We have a scenario planning to do that, but it's just not going to happen.
I see. So you're kind of citing an unrealistic possibility here, or levels that you don't see it coming to. Strategy obviously invented the DAT business model, and other companies have taken their cues from you to buy Bitcoin and other cryptocurrencies. Do you think these DATs, these companies, should take their cue from you if you do decide to sell some Bitcoin?
No, I think every DAT is different. I think every company should think about what is your treasury strategy as it relates to Bitcoin. DATs decide that that's their primary treasury reserve strategy to hold Bitcoin. Others might decide to put a 5 or 10% allocation to Bitcoin. Others might decide that they want to have access to Stretch and get 11% returns. I think DATs should operate on their own and do things that are right for them. And if they decide it's the right thing to buy Bitcoin or sell Bitcoin and Bitcoin down market, they can. It's not something we plan on doing.
Well, let's talk a little bit about the business of your DAT, because the point has been made over and over again that the number of DATs in the market right now, you could probably see some consolidation there. And plenty of them are trading at a discount to their actual Bitcoin holdings, Phong. So I wonder, instead of buying Bitcoin, would you ever consider buying one of these DATs, trading at a discount, and basically cracking them open like a piggy bank to try and get some of their Bitcoin, probably at a discount to what you would get in the open market?
I think in any new market, whether it be electric cars or AI or SaaS software companies, you want to focus on your core product and grow your core product first. And our core product is digital capital, and on top of that, digital credit, which is Stretch. I think it would be a distraction to go buy at a discount to net asset value another digital asset treasury company, just like it might be a distraction for one AI company to buy another or a software company to buy another. And they tend to not focus on their product. Our product is Stretch, and that's what we're going to spend time growing and developing. And the issue of buying other DATs isn't high on our list of things that we want to focus on strategically.
Operationally, what else were you focused on to make sure that strategy is providing value added to its shareholders beyond the holdings of Bitcoin in your treasury?
Yeah, it's really an increase in Bitcoin per share. And I think that's something that folks may not understand as well. We're not just holding Bitcoin, we're incrementing Bitcoin per share to our shareholders. We said over the next 7 years, we could double Bitcoin per share. That allows the company then to be able to accrete Bitcoin faster than the underlying asset, which is what's unique about us and makes us an operating company.
All right, Phong, always great to get some time with you. Appreciate you stopping by. That is Phong Le. He is president and CEO of Strategy. Now, coming up on The Close, we're breaking down those earnings results from McDonald's with Setyan of Mizuho. That conversation up next. This is The Close on Bloomberg. Welcome back to The Close. We do have some breaking news. This, when it comes to executive pay, Morgan Stanley boosting Ted Pick's pay to $45 million from $34 million. Again, we're talking about the CEO of Morgan Stanley. His name is Ted Pick, and he is getting a payday. Again, pay going to $45 million. That is quite a boost from the $34 million that he was receiving. We're going to continue to follow that story, but let's get back to McDonald's, of course, reporting earnings at the top of the hour. The big headline there that the market seized on was their comp sales, increasing in the fourth quarter by 5.7%. That is ahead of expectations of 3.7%, also beating on fourth quarter revenue and fourth quarter adjusted EPS as well. Let's break it down with Setyan. He is managing director over at Mizuho Securities. He covers the restaurant sector, joining us now. Nick, it's great to have you with us. So you take a look at some of the commentary on these numbers, and the first read seems to be that this is all about the value trade. You have consumers coming to McDonald's looking for a bargain. Is that your read as well?
Not necessarily. I think first of all, the almost 7% comp in the U.S. was the whisper number. It was well understood. It was well telegraphed, which is why the stock is up 5% month to date. It was driven by an unprecedented number of promotions within the quarter, but not necessarily value promotions. So we're talking about the Monopoly in October, the Grinch tie-in. There was also a Pokemon tie-in that was a little bit smaller. But I think that was the primary driver of the success in Q4. And then, the fact that we were going over the easier comparisons starting in October because of the food safety issues in Q4 of last year, that can't be underestimated either. Now, going forward, it's unlikely that numbers necessarily go up for 2026. The guidance of mid to high 40% operating margins That's versus a consensus, operating margin expectation of 47.5%. So I'm not sure that's going to allow numbers to go up. And we know the weather in Q1 has really undermined the comp as well. So I'm not sure if the comp momentum is going to continue in Q1 either.
Well, Nick, when you take a look at the landscape right now, when you take a look at the state of the American consumer, I mean, what do you think that McDonald's really should be prioritizing right now? Do you think they should be pushing harder on value, on promotions, and try to increase foot traffic, or does that have diminishing returns at a certain point?
I think McDonald's does have to focus on value. Its average check is up over 50% versus 2019. That's versus grocery up about 30% versus 2019. And because of beef inflation, franchisees are continuing to take, 3 to 4% type of menu price increases, even as some parts of the menu come down in price, including that extra value, menu, which is about 40% or so of McDonald's sales now. And so, overall, menu prices are actually still going up, even though they're trying to work very hard around that perception of, hey, we're still value, and we are trying to do things to appeal to that value customer. I'm not sure if it's going to work, once we get past the tough compares in Q1, starting in Q2 of 2026.
And Nick, we have just about a minute left with you, but of course we are awaiting that McDonald's call to start momentarily. What are you most interested to hear from management at this juncture?
So number one, I think all eyes are going to be on the Q1 comp trajectory, particularly in the United States. And number two is going to be why operating margins, guidance was maintained in that sort of mid to high 40% range. Consensus at 47.5% for 2026. And so especially if your expectation is for continued, top line momentum, why the mid to high 40%, operating margin? Why isn't it higher? Those are the two key elements that we'll be focused on the call.
All right, Nick, we'll let you get to it. Really appreciate you joining us to help break down those McDonald's earnings. That is Nick Setyan. He is Managing Director over at Mizuho Securities, covering the restaurant sector, focusing on McDonald's. When you take a look at the shares after hour, not too much movement. Initially, there was a little bit of excitement when we got those comp figures, but as Nick pointed out, that was the whisper number, and right now shares just about unchanged after hours. Much more coverage coming up on earnings and everything else. This is The Close on Bloomberg. Nike CEO Elliott Hill laying out his strategy to build momentum at the athletic wear giant in an interview with our own Romain Bostic this morning in Milan. Let's take a listen to some highlights from that conversation.
These moments, these sport moments, are critically important to our brand and, frankly, to the industry. They're tentpole moments, when, whether it's an Olympics, a Winter Olympics, a World Cup, a Super Bowl, an NBA All-Star game. And, frankly, they're really, I think, galvanizing moments for our teams internally to make certain we show up at our best. And we use those moments to take the relationships that we have with the world's greatest athletes and translate that into coveted, beautiful, innovative product as only Nike can do. And so these are critical moments for our company and for our brands. And no question, they're the moments that can help create a halo over the business side of the sport as well.
When we talk about the evolution of Nike, at your core, you are a road running company. In fact, the most recent quarter with the relaunch of the Vomero and the Pegasus line, 20% growth in your running business. There's another aspect of this, though, that's been picking up, a report that went viral a couple of years ago about the explosion of off-road running, trail running, if you will. And ACG, I would assume, fits into that in some capacity. Have you actually sat down and kind of gone over what the market is for trail running?
No question. So and by the way, it's not just trail running, it's the overall outdoor industry, if you will. And there's no question that consumers there is a movement to getting outdoors, and whether it's in China or in Europe or in the United States. And so we looked at the overall outdoor market and the opportunity that exists there. And there is some crossover, but it is incremental opportunity from a branding and positioning and a revenue perspective. So we decided to go after that through the lens of trail running, which is a point of strength from us, where we can bring innovation to the market and newness and freshness, and decided to do it with the ACG brand because there is some awareness already around that brand, and it has an attitude and that we think is new and fresh, and it brings something different to the outdoor market. So we're really excited about what ACG is going to do for us long term. As you think about China, we have to lead with sport and innovation, and that is the focus as we move forward, whether it's through running. Basketball is obviously big there, football, tennis is on the rise, and so you'll see us reposition the brand through the lens of sport, and it's not just through product, but it's through the athletes and the stories we tell, much more local. Another opportunity that we have is around the digital marketplace and making certain that we clean up the digital marketplace and then ultimately pay it off in physical retail. And again, I'm excited about what the team's putting in place and how we can move forward.
You know, you have put a big focus on the athlete and a refocus on sports. And it wasn't one of the first things you did when you got back. You kind of worked with the NFL to kind of make sure that licensing agreement got extended. I am curious, I mean, obviously American football, if you will. I mean, how important is it to have those types of agreements with the major sporting agencies?
Yeah. So, my first, just really quickly, story, my first slide that I put up when I walked out on stage October 14th was, we're a sport company and we're a growth company, and unbelievable applause in the room. And so there's no question we're focused on sport. And yes, the story's true. One of the first phone calls I made was to Roger Goodell. And we have a long-standing relationship, and we're excited about the extension that we have in place. Our brand showing up on the athletes, the teams, and the leagues around the world, no question helps position us. And we use those moments as our runways. And how do we elevate and drive innovation and design and look and feel that we can then leverage across the entire portfolio that we have of brands, different sports, and then footwear, apparel, accessories. So critically important to the success of our company moving forward.
You have a big focus on sports and the athlete. You are still, to a certain extent, a lifestyle brand, fashion brand, if you will, whether you want it to be or not. What's the strategy with that? I mean, you have the partnership with Nike Skims. Obviously, you have your own internal design that is very fashion forward here. What's the balance between going after that customer who maybe just wants it for lifestyle and fashion, and those who are looking for actual performance?
Yeah, I think the key is what separates us from any other fashion brand is sport. Is innovation, is design, is the athlete. And I think it's critically important that whatever we do and we will go after the sportswear business, we do it through the lens of sport and the athlete and what the athlete wants, needs, not only on the pitch, field, court, track, but also how they want to show up from a lifestyle perspective off those, off the field pitches, etc. So yeah, it is a big business. It'll continue to be a big business, but we are positioning it through the lens of sport. We even call it Nike sportswear versus lifestyle or fashion.
Are you happy so far with the partnership with Skims?
Yeah, that's gone really well. The launches, I think the combination of our two brands and the understanding that we have around performance and innovation in terms of some of the materials, what they bring from a body shaping perspective, and then from a footwear perspective, what we bring to the table, and the consumers responded. We just launched last week here in Europe, so we've now moved into Europe with it and had a great launch both in Paris and London. So really excited.
Do you anticipate doing additional partnerships, or is this kind of a one-off?
Oh, I think in our world, you always have to keep our eyes and ears open and our minds open to potential partnerships because I think the world and this collision of sport and culture is only going to accelerate, and it's our responsibility to make certain that we keep the aperture wide.
But you've been Nike has been at the nexus of that for years, for decades, really. And I am curious, like, what's more stable? I mean, is it the revenue that's generated from the lifestyle fashion folks, the cool kids, if you will, or on the performance side?
there's no question that we will always run our brands and our businesses through the world of sport.
Yeah.
That is who we are. That's what authenticates us. That's what separates us. That's what differentiates us. So sport, without question, will be the driver of our business moving forward.
With the Jordan brand, I mean, do you view that as a performance brand or a lifestyle brand?
The Jordan brand was founded in the game of basketball, and I think that the opportunity for the Jordan brand is to continue to dimensionalize through sport. We're lining up those teams that I've talked about, those cross-functional teams, against Jordan basketball, golf, which is true to who he is as a person. It's one of his passions. And so we have Jordan Golf that also, by the way, had a really nice launch. Football and baseball, played baseball, and then of course streetwear. So we are pushing to dimensionalize the brand beyond just streetwear, but also position it in sport, and not just about footwear, but also about apparel.
I want to say on basketball for a second. Obviously, Jordan is just a singular figure that not only helped the NBA, but certainly helped Nike. You look at the last NBA championships with Shai Gilgeous-Alexander, with the Oklahoma Thunder winning, wearing Converse, a brand that has struggled a little bit here. Do you see any potential of using somebody like Shai to maybe help to build up a little bit more buzz for that brand?
No question. I love what the team's doing and repositioning the Converse brand around the idea of creators. And there are creators, of course, in the world of culture, but there are also creators in the games that we play. And in the case of basketball, there's probably no more special creator than Shai Gilgeous, not only in the way that he plays on the court, but the way that he shows up from a style perspective. And from a Converse, I think we became very focused on the Chuck, and you'll start to see us dimensionalize through basketball, through skate, and then of course the Jack Purcell, which is setting out there as well. So you'll start to see a more.
So you're still investing in that.
No
brand.
question. And so you'll start to see more of a broad approach to the Converse brand moving forward.
There's no plans to sell off Converse. I mean, I'm sure you've heard the chatter.
Yeah, I've heard the chatter, and I've received even some of the phone calls. But no, we're committed to the Converse brand. We see it as an opportunity to address a different consumer than is the core consumer at Nike or the core consumer at Jordan. It's a separate and distinct consumer, and it offers us a separate and distinct opportunity from a revenue and profitability perspective.
There was a memo that was floating around that Bloomberg News obtained earlier this week saying that there were layoffs coming at the Converse brand.
Yeah. Well, I think anytime that we come through with a new strategy and a new approach and a new leadership and dimensionalizing the brand, we're having to look to where we reposition resources. And again, I'm excited about the strategy that we have in place and the structure that we're putting in place. And it's unfortunate, and I'm empathetic to some of those teammates, but yeah, we're having to reposition where we put our resources as we move forward.
And that, of course, was Nike CEO Elliott Hill. And joining us is the other man in the video. His name is Romain Bostic, joining us live from Milan. Romain, it's great to see you. And given that you are in Milan and I am not, let's start with the global perspective here, because, you were having the conversation with Elliott Hill that when it comes to North America, they have seen some success in winning back some of their retail partners. But obviously the ambition here is to extend that to other geographies as well.
Yeah, China being the most important, Katie Greifeld. We talk about this idea of 9% growth overall in North American sales and 20% when you look just at the wholesale channel. But that's just North America. China's still contracting, down 16% year over year. And really, no analyst is really projecting any sort of meaningful growth there anytime soon. I did talk to Elliott a lot about that. He did say, look, there is a strategy there to kind of refocus a little bit more on Nike branded stores. It's kind of a different culture over there where the people don't necessarily shop at kind of the multi-brand retailers like we do here. They tend to want to go specifically to a Nike store, something that they hadn't invested in as heavily as maybe they should have in the past. And that's going to be a big challenge to try to get things back on track over there. But the other big issue for them as well is also getting the other brands up. The Nike brand itself is doing well, but you've seen some slowdown in the Jordan brand. Converse as a brand is still contracting and contracting fast, and margins are falling off. So they've got to sort of find a way to sort of take the magic that they have with Nike, take the magic that they've had with the ACG relaunch, and see whether that can also apply to the other two big brands itself.
Absolutely, and it was interesting to hear him say to you that Nike is committed to that Converse brand, that does unlock a different type of customer, so we'll see what happens there. But what did he have to say about the competitive landscape? Because we know when it comes to sneakers, that has shifted a lot over the past couple years. As you know, I'm a huge Hoka fan, but there's also Ons, for example, and Adidas as well.
Yeah, I mean, this has been his mantra since he took over 16 months ago. A focus on the athlete, a focus on performance, and all of the technology, the design, and even the buzz that he's trying to create. It all circles back to this idea of whether this actually enhances in some way or at least complements athletic performance. It doesn't matter what question you ask him. It all comes back to that. And that's what they're pounding the table on. In addition to Elliott Hill, I had a chance to catch up with their lead designer, Martin Lodi. Same thing, a very fashion-forward guy. He's very big on aesthetics, but at the end of the day, he made it clear that they're not making anything right now that does not sort of put the athlete first. It does not put performance. And there's been a big focus on that primarily because, yeah, they lost market share because when they pulled back from the wholesale channel, who stepped in to fill those vacancies? It was On, it was Hoka, it was Altra, it was all of these brands that had a much more of a performance and athlete-focused basis, and that caught Nike off guard, I think. And Elliott Hill came back in here 16 months ago, and he made it very clear on day one that that is what they were going to do. And it doesn't matter what executive you talk to at Nike, they all come back to the performance aspect.
Well, Romain, it was a great interview. Looking forward to having you back in New York. Safe travels on your way here. That is Romain Bostic, my co-host here, of course, on The Close. Meanwhile, let's take a look at some of the notable movers in after-hours trading. Here are two earnings stories. Of course, McDonald's down about 0.7% right now. They did say on the call that the value meal momentum has continued in January. We'll see if that follows through for the rest of the year. And Cisco, wow, down by 6.4% there. The CEO did say that the company will have $3 billion plus in fiscal 2026 AI sales from hyperscalers, but you can see markets sending shares lower. This is The Close on Bloomberg. Well, we have a potentially banner year on deck for the IPO market. SpaceX, Anthropic, OpenAI, all possibly going public. Now, our next guest is heavily invested in private tech, including two of those names, SpaceX and OpenAI. His name is Sohail Prasad. He is founder and CEO over at Destiny Tech. The ticker there is DXYZ. He joins me now on set. Sohail, it's great to see you.
Great to see you. Thank you for having me.
So for those who aren't familiar, Destiny Tech, you operate as a closed-end management investment company. You came out with basically your earnings earlier today at 4 o'clock. And walk us through some of the highlights here, especially as it pertains to your investments and how those stakes have changed.
Sure. We listed DXYZ 2 years ago, and we said we wanted to create a portfolio that would bring public access to private tech. When we came out, we had in the 20s number of companies, and we're building out that portfolio to 100 companies over time. This was our biggest quarter yet. Quarter over quarter, our NAV grew 76%, and year over year, 210%. We also started expanding the portfolio to add a number of names that we're really excited by, and a lot of the public, uses on their day-to-day. So we made just a few weeks ago a $100 million investment in Anthropic.
And this always catches my eye that you have $200 million in cash at the end of the fourth quarter. That is a lot of dry powder to deploy. What does that look like over the next couple of months? What would be your target in terms of cash when you get to the end of this year?
Yeah, we don't have a goal for cash, but we're very active at deploying. I mentioned the $100 million we just invested to buy secondary in Anthropic. We have a number of deals in the works. And, when you think about our goal, it's to have 100 of the top private tech companies. So we can't comment on specific names, but all of the names that people know, use, and love, over time we want to add into our portfolio to kind of represent the best of late-stage venture.
And I'm curious about how you're getting access to these private shares. You mentioned secondaries in the case of Anthropic. I believe. Is that mainly how you're getting exposure? Are you going, into tender offerings? Are you going through SPVs? What does that look like?
Yeah, so we set it up to be as flexible as possible. And so with a company called Skilled AI, we just invested as part of their round led by SoftBank. We partnered with Beast Industries, which we're really excited about, to invest directly in the company. And so we try to work with companies who are doing primary financings. We buy out positions from VCs and others in the secondary market and try to be nimble to get best execution.
That's really interesting. And I have to ask, you think about some of the names in your portfolio, OpenAI, SpaceX, some of them. An interesting combination there, a potential IPO coming for SpaceX. How would you handle that in your portfolio? If you did have a company such as SpaceX go public, what would that mean for sort of your lineup there?
Yeah, so we invest in the later stages of private, and we've had companies go public before, like Instacart, like Klarna. We'll generally hold that investment through lockup and a bit afterwards, and then slowly divest the position over time, because our investors are really looking to us to get private exposure. We would then dividend out the profits and then reinvest into the then current top 100 companies.
I have to imagine that in some cases that is a pretty bittersweet moment when you think about, some of the big names in your portfolio, SpaceX being one of them. But, how often does that happen? Or does that naturally put you on the side of rooting for this private for longer mantra that we've seen?
No, every generation there have been defining private companies. There was an era when that was Uber and when that was Airbnb and Spotify. And so we always have these waves. We think it's beneficial for companies to go public. I've personally always wanted there to be more access for people to own a stake in the companies that are shaping the world. So generally, it's a great thing. I think this year, 2026, is going to be a banner year for IPOs. The top 3 names that you mentioned that are considering IPOs would represent almost 4 or 5% of the S&P 500 in market cap. So it's a really exciting time.
And we have to talk a little bit about the competitive landscape. I love talking about fund structures. I cover ETFs very closely. We know that the Barron First Principles ETF, the ticker there is Ron Bates out of Barron Capital. They have exposure to SpaceX. You also have that in interval fund form. The ARK Venture Fund is a really high-profile example there. How do you differentiate yourself and sort of socialize the idea of a closed-end investment management company to potential investors who do have a lot of options at this point?
Yeah, there have been, we led the charge in this. I've spent my entire adult life trying to bring public access to private tech. But there's not enough information out there. When you look at some of the interval fund structures like ARK, I call them fake liquidity. In their last full calendar year, they gave 20 million or so of liquidity to their investors. And at some investors who wanted to get out in Q3 2024 were capped and weren't able to sell. And so we really wanted a product that anyone can buy into or sell out of on an intraday basis on the NYSE. Ron B is super interesting, but has its own challenges. I think classifying SpaceX as a liquid security, there's a real mismatch in terms of inflows and outflows. When dollars come in, are they going to be able to balance that position appropriately? I think there's still questions.
Technically, it's classified as less liquid when you think about the 4 categories. But I hear your point there. You think about the different fund structures. There are pluses and minuses, especially when it comes to the liquidity profile. Sohail, great to check in with you. Really appreciate you making the time. That is Sohail Prasad. He is founder and CEO over at Destiny Tech. Now, still ahead on The Close, what investors need to watch over the next 24 hours. We'll set you up next. This is Bloomberg. Welcome back to The Close. Let's look ahead to what else we're watching over the next 24 hours. And we kick off pre-market with some earnings. We're getting Zoetis, of course. They're all about animal health. We'll also get Hyatt earnings as well. That is before the bell. Then you take a look what happens after market, what we're going to be walking you through. Coinbase, that'll be fun. Applied Materials, Roku, DraftKings, definitely a lot of interest there after the Super Bowl. We also have earnings coming from Instacart as well as Expedia, Airbnb, Pinterest, and Toast. So really covering a lot of industries there, different angles into the state of the consumer. In terms of what we're getting on the economic data front, we do get jobless claims at 8:30 a.m. tomorrow morning. It's going to be interesting to see if that matches up with what we got from our jobs day Wednesday this morning. We also get existing home sales. That comes at 10 a.m. Eastern. But that does it for us here on The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.